Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Today, I'm going to be talking about the big story of the week, Strategy's S&P 500 potential inclusion. So I'm going to break down the 6 ironclad checklist items that the S&P bouncer uses to decide who gets past the velvet rope. We're going to talk about how Strategy already lines up green ticks next to each box. And I also want to talk about why this isn't just another index shuffle. It is the moment where every 401k, robo-advisor, and pension fund accidentally ends up hodling Bitcoin. So let's dive straight into the checklist. So here is the velvet rope test translated into plain English. Number 1 is market capitalization. The club won't even check your ID unless you're worth more than around $22.7 billion. Strategy is showing up right now wearing a $95 billion name tag, so height requirement is cleared. Number 2 is the public float. At least 10% of the shares must actually trade in the wild. Strategy has roughly 97% floating, so that's plenty. Number 3 is the liquidity requirements, so the stock can't be a wallflower necessarily. It needs steady volume and at least 250,000 shares traded each month. Strategy's tape looks like Times Square on New Year's Eve, so no problem here. Number 4 is financial viability. You need a positive GAAP profit in the last quarter and the last 4 quarters combined to be considered. The accountant wants real cash, not just vibes, so Strategy's trailing 12 months are in the black and the box is ticked. Number 5 is seasoning and structure. You need at least a year of being listed on a major US exchange and the right corporate form, but Strategy has been traded since the 90s. Plenty seasoned. And then Number 6 is the fun one, the committee discretion. After the math comes the check from the committee. They're going to look at the sector balance and the headline risk. And, this is the only real wild card right now because Strategy's balance sheet is mega packed with Bitcoin and every hard metric is already green. So this is the scorecard we're going to look at for inclusion. Market cap, it obviously meets the rule by 4.2x. It meets the rule of the public float and the liquidity. With the last earnings report for Q2 2025, we saw a $10 billion in net profit. That makes it a yes for the last quarter and the last 4 quarters. A US company being listed on the NASDAQ since 1998 means a yes. And we all know there's no bankruptcy risk, no bankruptcy drama. The share classes are index legal and the float is well dispersed. So every single box in the fine print for the S&P inclusion says yes. And on every measurable stat, Strategy really isn't just barely clearing the bar, they're kind of doing a backflip over it. We're just waiting to see if the S&P committee likes that. So if we've passed every single hard rule with gold stars, the committee has to feel good about Strategy. So here are some questions that I think might keep them up at night. Number 1 is obviously the volatility, the Bitcoin whiplash. Strategy's earnings swing with Bitcoin like a carnival ride, so a 130% ugly drawdown can flip those shiny GAAP profits back into red ink. The committee hates surprise headlines, so they might want proof that the roller coaster has seatbelts. There is a bit of complexity with the share class as well. Besides the common stock, we all know that Strategy has a sampler platter of preferreds, Strife, Strike, Stride, and Stretch. They're all index legal, but unusual enough to make rule purists double check the fine print. This is another thing that I'm not sure how much will be weighed, but it is a potential variable. I think there is a bit of a tech overload going on. The index is already very top heavy with mega cap tech. If you add another 90 plus billion tech name, it might throw sector weights a little more off kilter. Maybe it's a possibility the committee will look at a broader balance before they finally rubber stamp it. It's very possible that because of the volatility of Bitcoin and how that influences Strategy's ability to mark a positive earnings gain for a quarter, we might see the committee give the rubber stamp in the early December window. The potential announcement expected this Friday, September 6th, would be the absolute first possible entry point for Strategy. So really, in plain English, Strategy is nailing the math, but whether it joins the club comes down to one boring question. Does the committee trust a Bitcoin-powered balance sheet to behave like a boring blue-chip stock, or does it keep them awake at 3 a.m.? We're going to find out soon, but I think everybody acknowledges that Strategy does not need the S&P. The S&P needs Strategy. This is a probability assessment just based on totally my own opinion, nothing scientific. Just my opinion and nothing more. If I'm given some handicapper's odds, I'm thinking the green light this Friday in September is about a 60%. Why it could happen? Because strategy passes every single hard rule and brings a juicy $95 billion market cap to a committee that might love some headline-grabbing ads. And I do think if Bitcoin stays firm into the end of this quarter, the bouncer's gonna let us straight in December. And that's where we would be watching the Q3 of 2025. I think one more clean quarter of gap profits would calm the nerves a little bit about the BTC price whiplash. A small wobble in Bitcoin or sector balance jitters could push the decision back to the December window. And then I would put a small percentage probability on a kind of temporary permanent veto. I'm not so sure that this is possible in the total long grand scheme of things, but the wild card scenario is the committee decides a company whose balance sheet is 630K plus Bitcoin feels more like a quasi ETF rather than an operating firm issuing Bitcoin-backed credit instruments. And I think that they might just, vote against it for good, at least for the foreseeable future. I think that we're basically a 2 to 3 favorites to make the S&P 500 this September, but a shaky Bitcoin candle or a cautious committee could definitely delay the party. So here's the fun part where we talk about the market impact from the passive fund flows. So if we're going to estimate the index weight, we have to look at the total amount of shares. There's 264.15 million in the latest float. The price of the August 29th close is $334.41. And with all these variables, you get to an implied starting weight of the S&P 500 at 0.162%, which is 16.2 basis points. That means when strategy enters the S&P 500 index, it would grab about 16 basis points of S&P 500 real estate. So the passive money pile, that is the cash sitting in index funds and ETFs that must copy the S&P pixel for pixel, is $7 trillion. So if you do the math between the $7 trillion and the implied starting weight, you're looking between 11 to 15 billion of forced buying of strategy stock. 16 basis points of a multi-trillion-dollar mountain equals roughly 11.5 to 14.5 billion dollars, or about 35 to 44 million shares at today's price. So when we talk about the timing of this, almost all of it will actually be at the closing bell. Fully replication ETFs of the S&P 500 fire market on close orders. So 2/3 to 4/5 of that demand hits in the first 24 hours. Think 22 to 37 million shares, which is 2 to 3x of Strategy's normal daily volume. You will see some aftershocks as well, benchmark chasing pensions, direct indexing platforms, and options desk hedges can add another 1 to 3 billion. That would come in over the rest of the week, turning day one fireworks into a multi-day glow. So let's look at the whole pie that the robots are going to be carving up. There are two mountains of money. Number one is the indexed, the true passive assets under management. That is about the $7 trillion living in ETFs and index mutual funds that must copy the S&P 500 exactly. So think SPY, think IVV, VO from Vanguard, and all those 401k target date funds on autopilot. The benchmarked, think of the looser passive or the closet active assets under management, is about another $20 trillion that uses the S&P as a measuring stick. So these managers track the index, then they sprinkle their personal flair on top, but they still hug it tight enough that they eventually buy the new additions. So why the distinction matters is because the index dollars are the mandatory shoppers. They're going to slam the buy button at the closing bell the day that strategy joins. The benchmark dollars are going to be the fashionably late guess. They drift in over days or weeks to kill tracking error and avoid awkward performance reviews. So if we translate that to strategy joining, our 0.16% starter weight means between 11 to 15 billion dollars of immediate forced buying from the indexed crowd. Even if just 10% of the benchmarked world follows within, let's say, a week, that's another $2 billion of demand. That is a bonus tailwinds that nobody's going to see coming until it shows up in the tape. So the indexed money is the freight train that is unstoppable and on schedule. The benchmarked money is the commuter crowd. They're still going to end up on the platform just with coffee in hand and 5 minutes late. So either way, once strategy passes as the S&P turnstile, trillions of dollars are pointed in its direction, and Bitcoin sneaks into retirement accounts everywhere. So yes, Grandma's pension fund in Peoria might soon own Bitcoin without a single congressional hearing, simply because the index robots said new stock loaded up. The theoretical day one buys from the index trackers are pretty entertaining when you look at the band of possibilities. The calculation is the forced dollar flow equals the index weight times the indexed assets under management. Using the 16.2 basis points weight and reasonable passive assets under management range, you see three different possibilities here. There's a conservative base case and upper bound case of $7.1 trillion, $8 trillion, and $9 trillion. So the share equivalence at today's stock price means that that's between a 34.5 million to a 43.7 million shares to buy. Why this is so exciting is because that's between 3 to 3.8x of Strategy's 3-month daily average volume, concentrated mostly at the closing auction of the effective date. That is a lot of money of forced buying. That $11 to $15 billion of forced buying, must-buy demand really shows up in the ETFs and mutual funds right here. That's going to be near 100% of target exposure at the closing cross. I think that that's going to be between 65 and 85% of the theoretical flow, with the indexed SMAs and segregated accounts typically making up between maybe 15 to 35% of the rest. Those are the pension clones that are going to be nibbling over the next few days, smoothing liquidity. So there is the benchmark HODLer cleanup crew. So remember that $20 trillion in benchmarked but not strictly indexed crowd, they hate tracking error shame. Even if 10% of them cave, that's another $2 billion of buying pressure flowing in. The options desks are going to continue to add spice as always. And the net result, I think, over the week is that the day one is going to be the fireworks show, but the grand finale is going to last between 4 and 5 trading days, with the total mechanical demand easily clearing between $12 billion and $17 billion. That is, once all the stragglers show up, of course. The price sensitivity of MSTR is obviously the huge built-in amplifier to the index weighting. So every 10% pop in Strategy's price before inclusion, we'll see how this week goes, but that's going to tack on roughly 1.6 basis points to its index weight. So, that'll be great on a way up, but brutal on a pullback. The index base effect is also the moving denominator here. The S&P's total float cap jiggles daily at today's level. Just 1 basis point of weight equals about $710 million of forced buying. If you shrink the denominator, the same BPS pulls in even more dollars, but if you expand it, you lose more suction. You also got to remember that Strategy loves the at-the-market sales folks. I love them too. Not everybody loves the ATM. I love it because, that's how they buy the most Bitcoin. But remember, a surprise issuance perhaps, or a float update the week before inclusion, the week of inclusion, who knows, it can shave or add billions to the passive flow math. There's just a lot of nuance here because Bitcoin's a wild card. Bitcoin can dump another 10%. Who knows? And this is all leading up into human discretion. Remember, the committee has the veto button. It's up to them. They can decide yes or no for whatever reason they want to. There might still be a 15% chance that the committee sees Strategy and they label it too crypto and slams the door. No matter how perfect the spreadsheet looks, you got to remember, at the end of the day, I think on Bitcoin X and Bitcoin YouTube, we're kind of living in a little bit of an echo chamber. That said, I think that this is inevitable. We'll just see. So in plain English, the passive flow freight train is going to be powerful, but the speed dial is sitting on 3 knobs: Strategy share price, the S&P size, Bitcoin's mood swings, and the red emergency stop held by the committee. Now, lots of exciting things on the horizon for Strategy, obviously. What I will say is that you want to sync your clock with the committee. In my opinion, remember, not financial advice, this is financial entertainment, but I have my position sized before the announcement window. Remember, the first shot window is September 6th, this Friday, the backup window December 6th. I'm going to be watching all of Q3. Why? Because a Q3 close above 100K is going to keep the gap profits green. The odds will remain in our favor, and a 30% Bitcoin faceplant could turn an inclusion bid into a no-go in December. I don't think this will happen, but it is a possibility. You can also trade the events. Remember, not financial advice, but you can do some call spreads into the decision that will capture the index pop if it happens without a max drawdown. You can also do some cheap puts that guard the no-ad trapdoor that has historically clipped 10 to 15% off runners. You can do some pairs hedging too, long strategy versus short S&P futures or Bitcoin futures. That will let you isolate the inclusion effect from the market or the crypto beta. I think a lot of the dialogue about this entire scenario is just the excitement behind the stock price on kind of an immediate basis. A lot of people are just zeroing in on what it's going to do to the stock price. Is it priced in? Is it not? Is this the ultimate test of the efficient market hypothesis? In my opinion, the most exciting story here, though, is the long-term, multi-year thesis of automatic buys into a Bitcoin vehicle that will continue to buy Bitcoin in perpetuity. In my opinion, this is the biggest catalyst moment for Bitcoin adoption. Obviously, you had a big one with BlackRock, the Bitcoin ETFs, IBIT, that kind of thing, but this is a huge moment for Bitcoin adoption when you have this much money just passively going into a flywheel that Saylor will continue to use, forced buys, more capital, just to continue buying Bitcoin. Set your alerts for this Friday. It's going to be exciting. Set them for the Bitcoin price. Size your risk so you can also sleep. And remember, the passive flow freight train can make you rich or roadkill depending on which side of the tracks that you stand. My name is Adam Livingston and I am the Bitcoin Wizard. If you enjoyed this video, please like the video and subscribe to the channel. Leave a comment with what you would like me to comment on next. I'm dropping daily Bitcoin insights, so do not miss anything. Have a terrific day, folks. Class dismissed.